what's up everybody? It's Monday, May 16th. I am back from Texas. Had a great time out there. Terlingua, Big Bend, the desert. Love the desert. So I'm back here, folks, and let's go over what's going on. I had a great time, I really did. All right, so today kind of a mixed bag. Dow was up. NASDAQ down, S&P down a little bit. But I do think last Thursday was the turnaround, and my reasoning for that, as I've explained, is due to the fact that net liquidity flows will be returning to the economy and the markets. And what do I mean by that? Well, you know, if you've been watching my videos over the last month and a half, I've been talking about the record fiscal surplus that the government took in from tax receipts, and that carried over into, actually carried over all the way until today. I mean, as of Friday, the federal surplus was 4.6 billion, and that was that's the narrowest it has been this month so far. And today we just got a 40 billion plus quarterly interest payment. We'll see the numbers on that tomorrow in tomorrow's daily treasury statement. So we're back into deficit. Now, deficit is a good thing. It's not a bad thing, because the deficit equates to a net addition to the income for the non-government, for the economy, right? That's the swimming pool filling back up. It has finally happened. I made that call too soon. I thought that in early May we would start to see that happen, but we continued to run, or the government continued to run a surplus basically through last Friday. And the reason for that, I explained, was the normal first of the month payments, you know, the stuff like Medicare, Medicaid, veterans benefits, military pay, disability, all that stuff that goes out on the first of the month, because the calendar, April 29th, ended on a Friday. You know, then it's done on the last business day of the month, because the first business day of the new month was May 2nd. So that's why May started off with a surplus. You had that spending that normally would have gone in the first, that came in April. So it boosted up the April fiscal flow. But look, the leading spending flows are still running around over 600 billion. I mean, we got to go all the way back to last July and before that to see consistent 600 billion plus spending months. You know, a big part of this too is Social Security, and I've been talking about that. I was mentioning this last year. I said that because of cost of living increases and because of, you know, expanding retiree roles, you know, I'm eligible for Social Security now. I'm not going to take it now, but, you know, I'll take it next year. The longer I wait, the more I get. And, you know, there's a lot of people like me, the so-called baby boomers, who are now going to be receiving Social Security. And that's just like a continual net expansion in the fiscal support until we all die off. Hopefully it won't be that soon for me, but you never know, man. I go to all these crazy places and go hiking. All right, so let's get serious here for a second, because there's a couple of things I want to talk about. First of all, let me repeat, net liquidity flows, and what I mean by that, I'll define that as, you know, deficit spending. That is resuming now as of today. So I think the market sell-off, and you can go back, and I did this earlier. By the way, today I put out the new issue of MMT Trader. If you want to copy that, go to my website. I'll put the link in here. It's pitbulleconomics.com. If you go back in around April 12th to the 21st, the market was establishing a bottom, and it was trying to stabilize. You know, we had all the rate hike worries and the inflation worries and everything, and the market had come down from the peak early in the year in January, and it was attempting to stabilize. And then on April 18th, with the tax payments, the tax filings, we had a huge liquidity drain. That was like a 330 billion liquidity drain. And right after that, the market just headed straight down. And then we had the May 16th Fed meeting, and there was a one-day rally. Remember, that was a big rally. Everybody thought like the Fed was, not going to get too crazy on the rate hikes. And that lasted one day, and still there was the problem was we had that massive liquidity drain. I mean, the government was just sucking out the money from, as a result of those tax filings. It was not spending it back out fast enough. It takes time for these things to revert back to their normal pattern. And now it's finally happening. I mean, now in May, we're back. This is today's May 16th. We're back in a fiscal deficit, which is good. That's a net addition to the financial balances of the non-government. That's us, the economy. That's positive. Now, I saw some interesting things in the banking data. For example, we saw the first drop in credit card and revolving credit loans in, I don't remember how many weeks. It was a while. The first drop in those loans in a while. And, I've been talking about those loans. I've been talking about consumer loans. I've been talking about how, the bank data has been very strong on the lending side. And I'm going to mention something else about the bank data in a second. But first, let me focus on the loan side. We saw a drop. Now, you might be saying, oh, that's a bad sign. It means consumers are tapped out. Not so fast. I don't think that's what it is. I interpret it differently. I think that is the first sign that the liquidity flows, in other words, you pay your taxes, your bank account goes down, okay? You got to tap your credit line, you use your credit card to make, purchases and payments because you just had to pay, the government their taxes. And it takes a little while for your income to start to replenish your bank account again. And once that happens, you could start relying less on the credit and spending more out of your income and your cash flow. I think that's what it is. It's lining up, I think, pretty coincidentally, that it seems to me that would be the explanation for the slowdown or the drop in credit card. I do not think it's because people are tapped out. I do not think that at all. Once again, credit, or how should I say this? Household debt service burdens are low. They're historically low, even though interest rates have gone up. There's also I'll say this too, there's also not a lot of evidence that the higher prices of gasoline are impacting demand to a very high extent. I think gasoline demand it's maybe down like 2% year over year. I mean, it's like not a big drop. It's almost flat, and we've had this huge price increase. So that's number one. The other thing that I found interesting in the banking data is that banks were huge sellers of securities in the data for the week ending May 4th. What do I mean by securities? I mean agency securities, MBS, that's mortgage-backed securities, trading assets, treasuries not too much, but it was the biggest drop in securities holdings of the banks in 13 years. As a matter of fact, agency securities, they fell the most in 16 years. I'm back in New York. You can hear that I'm back in New York. So, hang on. What's the takeaway from that? That's the question I'm asking. What do you think is the takeaway from that? I think the takeaway from that is a sort of a capitulation. And again, I went back and I looked at the price action of that week, of week ending May 4th. And in that week, you saw a big decline in bonds, in bond prices, and then a rebound the following week. So it looked like that week, the banks just that was it. They threw in the towel. They dumped like the biggest quantity of securities that they've ever dumped in 13 or 16 years. And then we had a big rebound in bond prices the following week, and it looks like we're having a little bit of follow through on that. There was another sign of capitulation I saw that right now, and this didn't happen necessarily in a single week, but I noticed that institutional asset managers, if you look at the CFTC's commitments of traders release that comes out every Friday, institutional asset managers now have the smallest net long S&P futures position in 6 years. I mean, think about it. Where, they had been running a net long position of about 700,000 or 800,000 contracts. That's net long. That's total longs minus total shorts, for a very long time. And now they reduced that all the way down to 277,000. That is the lowest net long position for institutional asset managers in 6 years. So they're basically out of the market. They're basically out of the market. So it looks like you had that bond capitulation by the banks a couple of weeks ago. It looks like as of last week, last Tuesday, that S&P institutional asset managers are the least long the S&P in 6 years. You got liquidity, real liquidity. This is not the phony, like I always say, the phony, Fed monetary operations, which people don't understand, which is just asset swaps. Every single time it's exchanging one asset for another. This is real liquidity. This is the government putting money back into the economy. I mean, this is what we needed to see. So notwithstanding today's price action, I mean, you're not going to go, I don't think we're going to get a V bottom because it's still, economy is still kind of fragile, and people are still worried about a lot of stuff. I mean, you had oil hit like 112 today. You still have a lot of interest rate worries. You got Fed worries. Powell is talking tomorrow. What's her name? Lagarde of the ECB is talking tomorrow. She's probably going to, that's going to kill the euro. So yeah, I think we're at a turning point. I think the worst is over. Fiscal flows, the leading flows are good. We needed to see the budget position of the federal government go back into deficit as a net, because that means they're once again a net supplier of liquidity. And that hasn't happened for, basically like a month. And we've been through a brutal month, and that explains it. I mean, you suck away all that cash from people, and the government just sucks out all that cash in taxes, and then it takes its time to spend it back into the economy. We're all waiting for that money to flow back in. It may not flow back in directly to us, but indirectly it comes back to us in the form of, economic activity starts to pick up again. The markets start to pick up again. You get the summer rally. This stuff is it's all a pattern. It's all seasonal. It's just like the thing is nowadays, because we went through the last 2 years of pandemic stimulus, we got a little bit jaded. We got a little bit complacent about the market just goes straight up because they've been pumping trillions and trillions in and all kinds of stimulus and government support programs and stuff like that. I mean, so we're kind of getting back to the old days, the way it was when, it was like a two steps up, one step down, whatever. And that's the normal way markets usually trade. I mean, before we had all this fiscal. So that's my update for today. I'm back in New York. I like the West. I really enjoy going out there. It's already raining here. It's crazy. All right, everybody. See you tomorrow. Bye.